Right, so you've decided to move home. Maybe the family's outgrown the place, maybe you finally accepted the box room was never ever going to be used as an office. Or maybe you've just walked past a for sale board on a nicer street and something in your brain went, ooh. Well, whatever's got you here, I want to tell you something straight away. Because nobody else seems to be saying this. Moving home is not the same as buying your first one. It feels like it should be. You've done it before, you know the drill, you know how hard it can be. And then you discover that this time you're not just a buyer, you're a buyer and a seller at the same time. And the two things have to dance together perfectly, or the whole thing just falls over. I've sat down with loads of home movers, lovely people, sharp people who got blindsided by stuff they'd never even have heard of. Porting, early repayment charges, the stamp duty surcharge that lands on your doormat when you've done absolutely nothing wrong. So this is the complete home mover journey, start to finish, every stage, every trap, every bit that quietly costs people money when they don't see it coming. Grab a brew, get comfy, because we're going to do this properly. And a quick honest note before we start. The numbers I'll mention, the stamp duty bands, the base rate, all of that, they're right at the time of filming. But they do shift over time. So always check the current figures or give me a shout and I'll tell you exactly where things stand today. So let's get into it. Here's the thing that makes moving home genuinely harder than buying your first home. When you bought your first home, you had one job, buy a house. That was it. You found a house, you got a mortgage, you moved in. One transaction, one set of nerves to strain. But now you've got two. You're selling the home you're in and you're buying the next one. And those two deals are joined at the hip. The money from your sale becomes the deposit for your purchase. The timing of one drags the timing of the other. If your buyer pulls out, your purchase wobbles. If your purchase falls through, your sale's left hanging. Think of it like one of those circus acts where someone's spinning plates on poles. On a good day, it's beautiful, mesmerizing. On a bad day, you're sprinting between two poles trying to stop the lot smashing on the floor. The good news, you don't have to be the plate spinner. That's literally my job. But you do need to understand that you're juggling two things now, not one, because almost everything in the video comes back to that one simple fact. So let's start by talking about timing, because this is where people lose money before they've even started. Most of you watching are on a fixed rate mortgage right now, a 2-year fix, a 5-year fix, something like that. And here's what catches people out. If you pay off that mortgage before your fixed period end, your lender can charge you what's called an early repayment charge, an ERC. And these are not small amounts of money. We're talking about 1 to 5% of your outstanding balance. So on a £200,000 mortgage, a 3% charge is £6,000 gone before you even start. Just for the crime of wanting to move house at the wrong moment. Now, before you panic and cancel the whole move, there's a brilliant get out. And it's the subject of the very next chapter. So hold that thought for a minute. But the headline is this: know when your fixed rate ends before you do anything else. Dig out your mortgage paperwork or open your lender's app and find the section labelled ERC. It's the single most important number in your move, and most people have absolutely no idea what theirs is. Now, if you're coming to the end of your fixed deal anyway, brilliant. Timing's working in your favour. If you're slap bang in the middle of one, we just need to be a bit clever about how we structure things. So that get out clause I mentioned, it's called porting. Porting means taking your existing mortgage deal, the rate and all, and carrying it over to your new property, a bit like taking your phone number with you when you switch networks. Same deal, new home. And crucially, if you port, you usually dodge that early repayment charge because you're not actually ending the mortgage, you're just moving it. So that sounds perfect, and sometimes it really is. If you've bagged a lovely low rate a couple of years back, porting can save you a small fortune compared to taking out a brand new mortgage at today's rates. But, and there's always a but, porting isn't a magic wand. A few things you need to know. First, porting isn't guaranteed. Even though it's your existing deal, your lender rechecks your affordability all over again, as if you're a brand new applicant. So if your income's dropped or your outgoings have ballooned or you've taken a shiny new car on finance, you might not pass. The deal's portable in theory, but you've still got to qualify. Secondly, the maths get really fiddly when you're borrowing more. Most movers are buying something bigger and pricier, so you need a bigger mortgage. What happens then is you port your old rate on the old amount and you take a second chunk of extra borrowing at today's rates. 2 sub-accounts, 2 rates, often ending at different dates. It's not the end of the world, but it's a faff and it needs managing properly. So the honest answer to should I port is the answer to almost everything in my world. It depends. It depends on your rate, your ERC, how much more you're borrowing, and what's available elsewhere. Sometimes porting wins, sometimes paying the ERC and starting fresh actually works out cheaper. The only way to know is to run both and compare them side by side, which funnily enough is exactly what I can do for you. Right, so let's get on to deposits. This is the bit that's actually quite lovely for home movers, so let's enjoy it for a minute. When you bought your first home, you had to scrape a deposit together, saved for years probably, skipped a few holidays, raided the bank of mum and dad, sold a kidney on the quiet. We've all been there. This time your deposit's probably already sitting in your current house. It's called equity. It's simply the difference between what your house is worth and what you still owe on the mortgage. So say your house is worth 300,000 and you owe 180,000 on the mortgage, you've got 120,000 pounds of equity. When you sell, you pay off the mortgage, and that 120 grand minus your moving costs becomes the deposit for the next place. For a lot of movers, that's a genuinely big deposit, bigger than most first-time buyers could ever dream of. And a bigger deposit means a lower loan to value, which means access to better rates. So moving up the ladder isn't just about a bigger house. It can mean a stronger mortgage position too. But one word of caution though, don't spend that equity in your head before it's real. House prices move. Your actual sale price might come in a bit lower than the estate agent's wildly optimistic valuation. And your costs are going to nibble away at that cash. So treat the equity as a strong estimate, not a fixed figure, until contracts are actually signed. Now here's something about this that genuinely surprises people and not in a good way. You might assume that just because you got a mortgage last time, getting a bigger one now is just a formality. You've been paying it perfectly for years, surely they trust you by now. The mortgage world doesn't quite work like that. Every single time you borrow, even when you're just moving, the lender reassesses your affordability from scratch, using today's rules and today's circumstances in today's market. And a lot can change in the years since you last bought a house. Maybe you've had kids and childcare is now eating a serious chunk of your income. Maybe you've taken a car loan or a couple of credit cards or a buy now, pay later habit that crept up on you. Maybe interest rates are higher than when you last borrowed, which is going to tighten the affordability sums. All of these things will shrink how much a lender will actually hand over. And the flip side's true too. Maybe you've had a pay rise, cleared your debts, and the kids have flown the nest, in which case you might be able to borrow more than you think. The point is, don't assume. Before you fall head over heels for a 4-bedroom place at the very top of your imagination's budget, let's actually work out what's borrowable. Because the most heartbreaking thing in my job is watching someone find their dream home and then discover the numbers just don't stretch. Let's flip that right round. Find your numbers first, then go shopping with total confidence. Okay, so there's also a big strategic dilemma we need to talk about. Do you sell your current home first or buy the new one first? There's no perfect answer here, only trade-offs. So let me lay them out plainly. If you sell first, you know exactly how much money you've got to play with. You become what estate agents absolutely love, chain-free proceedable buyer, which makes your offer much stronger. The downside? You might end up homeless for a bit, having to rent, or move in with your relatives. The spare room at your mum's, the sofa, the slow descent into being 38 and living with your parents again. Absolutely not ideal. If you buy first, then you avoid that gap. You move straight from old home to new. But you're making an offer without knowing your own sales agreed, which makes you a weaker buyer. And worse, if you complete on the purchase before selling, you can get clobbered by that stamp duty surcharge. And we're going to talk more about that in a moment. But for most people, the realistic answer is you do both at once in a chain. And you try to line up the completion dates so you sell and buy on the same day. Removal van outside the old place in the morning, keys to the new place in the afternoon. It's stressful, it's a logistical ballet, but it's how the vast majority of home moves actually happen. Which brings us very neatly to a thing everybody dreads: surviving the chain. So you wind up in a chain. And the chain is 2 little words guaranteed to make any home mover's eyes twitch. A property chain is just a line of linked transactions. You're buying from someone who's buying from someone else and who's selling to someone else who's selling to someone, and so on and so forth. Everyone's completion depends on everyone else. It's like a conga line where if one person trips, the whole line's going down. The longer the chain, the more that can go wrong. Somebody's survey throws up a problem. Someone's mortgage falls through. Somebody somewhere gets cold feet, and because Mercury's in retrograde, and because you're all linked, their problem instantly becomes your problem. So how do you survive in a chain? Well, a few things are going to genuinely help. One of those is getting your mortgage sorted out nice and early so you're ready to move the moment that everything gets lined up. Ideally, get yourself a really switched-on solicitor, because slow legal work is the single biggest cause of chains collapsing. And keep talking. Stay close to your estate agent and your mortgage advisor. That'll be me, by the way. So the moment something starts to wobble, we all know about it and we can do something. You can't control the whole chain. Nobody can. But you can absolutely make sure you're the strongest, fastest, best prepared link in it. So you're never the reason it breaks. Right, so let's talk about stamp duty for a minute. Or to give it its full Sunday name, stamp duty land tax. That's if you're in England or Northern Ireland. Scotland and Wales have their own versions with different names and different rates. So if you're up there or over there, the principle's the same, but the numbers differ. For a standard home mover buying their main residence, here's roughly how it works. On the bands as they stand whilst I'm filming this, there's nothing on the first 125,000, 2% on the slice between 125 and 250,000, 5% on the slice from 250,000 up to 925,000, and it climbs from there. So on a £300,000 home, you'd pay nothing on the first chunk, £2,500 on the middle slice, and £2,500 on the top bit, £5,000 in total. It works just like income tax in slices. You don't pay one single rate on the whole lot. Now here's the trap, and it's a horrible one. There's a surcharge, an extra 5% on top of everything if you're buying an additional property. It's really aimed at landlords and second home buyers. But, and this is a genuinely cruel bit, if you complete on your new home before you've managed to sell your old one, even for a single day, the taxman treats you as owning two properties and slaps you with the surcharge. So on that same £300,000 home, there's an extra £15,000 of stamp duty land tax. That's a big ouch. But, and just take a breath for a second. Here's the part almost nobody tells you. If you sell your old main home or residence within 36 months of buying the new one, you can claim that surcharge back. You apply to the taxman and they refund it. The deadline to claim is 12 months after you sell the old place, so please don't sit on it. And if you do get caught by an overlap, it's painful on the day, but it's usually fully recoverable. Just know that it's coming, budget for it, and get the claim in on time. This stuff is exactly why having someone in your corner matters. I'd much rather warn you about a 15 grand bill before it lands than commiserate with you after it has. Now we've got the stamp duty out of the way, a quick but important one, surveys. When you're buying, your lender's going to do a valuation, but understand what it actually is. It's not for you, it's for them to check the house is basically worth what they're lending against. It's a quick once over. It's not going to tell you that that beautiful period cottage you've always dreamt of comes with creeping damp, a dodgy roof or subsidence that's quietly redecorating the lounge with cracks. For that, you want your own survey. A home buyer's report for most standard homes or a full building survey for older, bigger or quirkier properties. Yes, it costs a few £100, and yes, it's tempting to skip it to save money when you're already hemorrhaging cash. But please don't. A survey that turns up a £5,000 problem either saves you £5,000 because you renegotiate the price, or saves you from buying an absolute money pit altogether. It's the cheapest insurance you will ever buy on the biggest purchase you'll ever make. And the bonus? If it flags something up, that's often a chance to go back and gently chip away at the price. The survey pays for itself far more often than not. And arranging surveys is something that I can do as an add-on. I can sort it out for you. So you don't have to go out there hunting for a surveyor yourself. Just give me a call and I can get it set up for you. Now, this is the chapter you're going to want to skip, but please don't. I can already see some of you reaching for the fast forward button. Stop it. Stay with me because this is one that actually matters most. When you're moving up the property ladder, your mortgage usually gets bigger. Makes sense, right? Bigger house, bigger loan. But here's what people forget. A bigger mortgage means a bigger risk hanging over your family if life goes sideways. If you set up life cover or income protection years ago, back when you had a smaller mortgage, there's a very decent chance it no longer covers what you owe. You've upgraded the house, but you've left your safety net exactly the same size. And the gap, the bit that's no longer covered, that's the bit that's going to land on your family at the worst possible moment. Let me try and put it plainly without being morbid. If you couldn't work for 6 months because of illness or accident, could you keep paying that new, bigger, shinier mortgage you've just got? If the very worst happened to you or your partner, would the one left behind be able to stay in that house? For an awful lot of families out there, the honest answer is not for long, and that's exactly the thing we can fix in an afternoon. Life cover, critical illness cover, income protection, these aren't upsells, they're the reason the bank trusts you with that much money in the first place. And moving home is a perfectly natural moment to review it all. Get the house and the protection sorted together and you actually get to enjoy the new place instead of quietly worrying about it. Quick note on this, protection policies have no cash in value and the cover ends if you stop paying premiums. Definitions and exclusions vary between insurers, so it really is worth getting proper advice on the right type and amount of insurance you need. So we've got this far. You've had your offer accepted on the new place and you've accepted an offer on yours. Champagne moment, right? Well, not quite. Now comes the legal stage and the conveyancers are going to get stuck in. Your solicitor or conveyancer is going to be doing lots of unglamorous but absolutely essential work in the background over the next few weeks and months. They handle the contracts, run the searches, the local authority checks, environmental, water and drainage, all the things that tell you whether someone's about to build a motorway through your back garden. They liaise with the other side's solicitor, sort the transfer of the money, and register you as the proud owner with the land registry. But there's two honest truths about this stage. One, it's usually the slowest part of the whole process, especially the land authority search, which can take weeks. Two, the quality of your solicitor makes an enormous difference. A sharp, responsive conveyancer keeps a chain alive. A slow, impossible to reach one can sink it. So this is really not the place just to pick the cheapest name on a comparison site. Sorting good solicitors for both your sale and your purchase is absolutely one of those things I arrange for clients, because the smoother the legal bit runs, the less likely your move is to turn into a proper horror story. And of course, once your solicitor ploughs through all that list of jobs they've got to do, you finally get to exchange of contracts, the point where it all becomes legally binding and nobody can pull out. And then a few days or a couple of weeks later, completion, the day you actually get the keys. From offer accepted to completion, a typical move takes somewhere between 8 to 12 weeks, though a long chain can stretch that out massively. So having got through everything, you've exchanged contracts, completion days in the diary, and it's nearly real. Let's talk about some of that unglamorous stuff that, if ignored, turns moving day into a full-blown disaster movie. Book your removals early. Good firms get booked up fast, especially around month end, and surprisingly, on Fridays, when half the country seems to want to complete. So leave it too late and you're either paying a premium or you're loading a transit van yourself at 11 o'clock at night, which, trust me, is nobody's idea of a housewarming party. Sort out your building insurance so it's live from the day you exchange, not the day you complete. Because legally, you're on the hook for the property from exchange. A lot of people get that one wrong, and it's a nasty gap to have. And then the admin conga line. Redirect your posts with Royal Mail. Tell the utilities, your council tax, water, gas, electricity, broadband. Update the bank, the DVLA, the dentist, the lot. It's tedious. It's the household equivalent of doing your tax return. But get it all done the week before, and moving day itself becomes about pizza on the floor and arguing about where the telly's going to go, rather than a stressful panic. And just a side note on the subject of utility bills, sorting out your energy and broadband switches is yet another thing I can give you a hand with. Moving's the perfect time to make sure you're not overpaying from day one in a new place. So that's the journey. And if your head's spinning slightly, then good. That's the honest reaction you should have. Moving genuinely is a lot of stuff. But here's the reassuring part. You don't have to do this alone. What I actually do is I sit right in the middle of all of it and pull the strings. So you don't have to. I work out what you can borrow before you go shopping. I can compare porting your existing deal against a fresh mortgage and tell you straight which one's going to be better for you. I find you the right lender and the right rate from across the whole of market, not just one bank shelf. I can flag up things like stamp duty traps before they bite. I review your protection so the bigger mortgage doesn't quietly become a bigger worry. And I can line up your surveyor, your solicitors, and even your utility switches. So the whole thing runs as one smooth operation instead of a dozen separate headaches. And because people always want to know, let me be upfront about my fees. For a standard residential mortgage, I charge £495. That's payable on mortgage offer. If you're already an existing client of mine, your remortgage is free because I'd rather keep you happy for the long haul. There's no hidden surprises. That's what I charge. You'll always know the cost before we start. I work with people right across the UK, face-to-face, on the phone, over video, whatever suits you best. I happen to be based in Earl Shilton near Hinckley in Leicestershire, and I do love looking after my local folks around Hinckley, Lutterworth, Market Harborough. But honestly, wherever you are in the country, I've got you. So if you're thinking about moving this year or next, do me one favour. Don't wait until you've found the house to get your ducks in a row. Get the boring bits sorted first, the borrowing, the timing, the protection, and then go and enjoy the fun part, which is nosing round other people's houses and silently judging their wallpaper. If you'd like a hand with any of this, you know where I am. The links to get in touch are right below this video and in my bio. I'm Patrick Weightman, your locally Smithers mortgage and protection advisor, serving clients up and down the UK. Drop me a like and a follow for more and hit the links in my bio to get in touch. Obviously, think carefully before securing debt against your home. Your property may be repossessed if you do not keep repayments on your mortgage. Speak to you soon. Bye-bye.